good evening and welcome to class. Hope you are very fine this evening. So confirm whether we are together, then we can start. You can just say good evening. You can just say good evening. I can see ARG says good evening. ARG says good evening. What about the rest? I can see a number of you having to say good evening. So in this case, we can actually continue from where we left in our previous class. We were looking at, in this case, special transactions and how you could end up having to treat them when you're having to do consolidation or conduct, in this case, what consolidation, or come up with a consolidated financial statements. I think we had actually gone up to number 6. That was, I think, in this case, goodwill. It was up to number 6. Was it number 6 or number 5? Number 5, I think we had gone up to number 5. Number 5, we in this case looked at goodwill. We in this case looked at goodwill. So we are just remaining with 3 of them. Then in this case, I think we can be able to look at a comprehensive illustration from the past papers. So in this case, you can be able to write number 6. Number 6, fair value adjustments. Fair value adjustments. Fair value adjustments. So number 6, you can be able to write fair value adjustments. Fair value adjustments. Fair value adjustments. So when you talk about fair value adjustments, sometimes in this case, you might be told that the subsidiary ended up having to revalue its assets, maybe on acquisition or maybe during the post-acquisition period. So how do you actually end up having to treat this? So you can be able to write fair value adjustments. So IFRS number 3 requires, IFRS number 3 requires identifiable, requires identifiable. IFRS number 3 requires identifiable assets and liabilities. Identifiable assets. Identifiable assets and liabilities. Identifiable assets and liabilities of the acquiree. Of the acquiree or subsidiary. Of the acquiree or subsidiary. IFRS number 3 requires identifiable assets and liabilities of the acquiree or subsidiary to be measured initially, by the acquirer, holding company, by the acquirer holding or parent company, by the acquirer or holding or parent company, at their fair value, on the date of acquisition, on the date of acquisition. So that in this case, when the parent company is having to acquire the asset, or in this case, the subsidiary, at that particular point in time, they're having to acquire this subsidiary. They must have been able to value those assets at the fair value, at the prevailing market value of these assets. So considering in this case the prevailing market conditions, what is the value of these assets? That is the value at which in this case they're supposed to do it, to be valued. They are supposed to be valued. So in this case, they can be able to make what are relevant fair value adjustments and ensure the assets are having to be acquired, in this case, at their fair value. At their fair value. So you can be able to write when the subsidiaries assets are revalued, 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 on acquisition, when the subsidiaries assets are revalued on acquisition, when the subsidiaries assets are revalued on acquisition, comma, the subsidiary, the subsidiary may not have incorporated the revaluation in its own books, may not have incorporated the revaluation in its own books. So in this case, you revalue them on the date of acquisition. The subsidiary might not in this case have considered that revaluation in their books. So because in this case, you're having to say, for example, if you acquire on 1st of January 2025. So the assets, in this case, all of them will be, like in this case, you'll value them at the prevailing fair value, or the market conditions that are having to prevail will determine the value of those assets having to be acquired by the parent company. But now, the subsidiary might not have actually recognized these revaluations. You're having to talk about on the date of what? Of acquisition, on the date of acquisition. So in this case, if this is the case, then you write in this case, you write in this case, the revaluation needs to be adjusted before consolidating the subsidiary. In this case, the revaluation needs to be adjusted before, in this case, the revaluation needs to be adjusted before consolidating. Needs to be adjusted before consolidating the subsidiary. Need to be adjusted before consolidating the subsidiary. That you'll have to consider that evaluation. So in this case, the assets in the books of maybe the subsidiary were maybe 10 million. Then you are told on the date of acquisition, the assets were measured at a fair value of 12 million. So the extra 2 million in this case has to be considered before you end up having to do what? Do the consolidation. Or in this case, when you're having to consolidate, you have to consider that. So what will happen in this case, it means there will be an increase of like 2 million on the value of the assets. So in this case, you can be able to write the final point. What happens now in this case regarding depreciation on the extra amount? What happens regarding depreciation on the extra amount? So depreciation adjustments may also be required for assets which are to be depreciated. So the depreciation adjustment may also be required. Depreciation adjustments may also be required. For assets, which are to be depreciated. For assets which are in this case to be depreciated. So in this case, you consider the depreciation, in this case, what the revaluation. So in this case, also you account for it. So in this, if you look at in this case, what we are looking at, what in this case we were looking at when you are calculating goodwill. There's somewhere in this case you're having to say you consider what you call pre-acquisition, in this case what? Reserves. So sometimes in this case you'll be told when the assets were being acquired, when the company was having to acquire, they revalued in this case what? The assets from maybe in this case 10 million, in this case what? 12 million. So this creates a revaluation in reserve of 2 million. So what you're having to put there as the pre-acquisition reserves, sometimes you normally consider this figure. If you are told the values of the subsidiary company were revalued up to this amount, so it means that revaluation in this case would have actually been created, and therefore when you're calculating goodwill, this is what you're having to say you have to consider it. When you're calculating goodwill, you'll end up having to consider that what? Revaluation. And of course, you'll be able to see it in some of the questions. Once you look at that question, you'll be able to see it. So that's in this case, you treat what? Any fair value adjustments on the assets. So it's a requirement. The parent company does what? The revaluation, or revalues, in this case, the assets to fair value. If that happens, it means that the revaluation reserve that will be created, which in this case is normally considered as a pre-acquisition revaluation reserve, which in this case you can be able to consider when you are calculating the goodwill, because this now will likely end up having to be part of the net assets of the subsidiary on the date of acquisition, and therefore you'll consider it when you're calculating the goodwill. When you're calculating the goodwill. So we can look at now in this case the so we have in this case what is remaining: computation of NCI and computation of, in this case, what retained earnings, computation of retained earnings and NCI. So maybe before we look at that, I want us to look at an illustration. We can look at an illustration. Then in this case, I'll be able to show you later how in this case you can actually be able to compute the NCI and the retained earnings. So let's look at an illustration first of all. Let's look at an illustration first of all and see how the examiner will end up having to test some of these questions. So you can be opening December 2024, question number, it is December 2024 question number, is it question number 2 or something? December 2024 question number 2B. So hope you can be able to see that question. December 2024 question number 2B. December 2024 question number 2B. So open that particular question. December 2024 question number 2B. December 2024 question number 2B. So are you there? Once you're there, you tell me you are there. So once you're there, you tell me you're there. December 2024 question number 2B. What you've just looked at is a continuation of what we had done in the previous class. The point you've looked at, it is point number 6. Key adjustment number 6, fair value adjustments. So we just continue from where we left in our previous class. If you are not in our previous class, it means then you are lost a bit. You are lost a bit. So you need to be on track by adding towards the previous class video. So if you're there, you tell me you are there. So I can see you are saying yes. Yes, you are there. But before, in this case, we do that question. Before we do that question, so you can be able to write this NB. Write this NB. NB. You can be able to write this NB. Before we look at that particular question, write this NB and say, if the subsidiary was acquired in between two financial reporting dates, if the subsidiary, NB number 1, if the subsidiary was acquired, if the subsidiary was acquired in between two financial reporting dates, in between two financial reporting dates, if the subsidiary was acquired in between two financial reporting dates, comma, the items in the consolidated statement of income, the items in the consolidated statement of income, the items in the consolidated, the items in the consolidated statement of income, the items in the consolidated statement of income, the items in the consolidated statement of income will be apportioned appropriately, will be apportioned appropriately, the items in the income statements will be apportioned appropriately according to the time period, according to the time period, the subsidiary, according to the time period, the subsidiary existed as a member of the group. The subsidiary existed as a member of the group, as a member of the group, existed as a member of, in this case, what, the group. So in this case, if a subsidiary was acquired in between the year, so in this case, you'll likely be given two income statements. You'll be given the income statement of the parent, the income statement of, in this case, what? The subsidiary. So in this case, you'll be told sales is actually maybe 60. This one is actually maybe 30. You'll be told cost of sales. This one is maybe 90. This one is actually not 90, but you can be able to say maybe 40. This one is actually what? 15. Then you are told the subsidiary S was acquired on 1st of June 2025. The subsidiary in this case S was acquired on 1st of June 2025. And in this case, the financial statements you are preparing are as per 31st of December 2025. So this means this subsidiary existed as a member of the group for how many months? It was acquired here. It means it existed as a member of the group for how many months? It means it existed as a member of the group for how many months? Yes, I can see you are saying 6. So that's where the problem is. That's where the problem is. So you need to be very careful with the dates. It is 7 months. You need to be very careful. Now, that is one of the tricks in the exam that will be there. When you see a date, when it was acquired, be very keen about that. You will say 6 months and it is 7. It is 7, it is 7, it is 7, it is 7. It is 7. You see the trick? You need to be very keen about the date of acquisition. You will say 6. Then you apportion the items using 6 months. It is supposed to be 7 months. You have to be very keen about the date of what? Acquisition. That's one of the tricks the examiner uses. So you'll be using 6 to apportion. It is supposed to be what? 7 is supposed to be 7. This means in this case, when you are consolidating, this is what you'll be doing. You'll be saying for sales, you'll be saying in this case 60 plus 7 out of 12 times 30. Then now we consider any other adjustments. For example, intercompany sales, we were there during the post-acquisition period, we'll consider. When you go to the cost of sales, we'll likely be saying in this case 40 plus 7 out of 12 times 15, because the subsidiary existed for how many months? 6. This is what this statement means. You apportion appropriately according to the time period the subsidiary existed as a member of the group. It existed as a member of the group for 7 months. So when you're consolidating, you apportion these items in the income statements according to the time period it existed. So that's very important. You take note of that. Don't forget, if in this case you don't apportion, then things will go marambas for you. Imagine you will end up having to score a 0 in the statement of consolidated income. Just imagine. So number two, just begin now in this case about number 2. What about number 2? In this case, the items in the statement of financial position, will be added line by line. The items in the statement of financial position, will be added line by line. Without apportionment. According to the time period. According to the time period. Will be added line by line. You can underline line by line without apportionment. You can underline line by line without what? Apportionment. Here, you can be able to underline will be apportioned appropriately. Will be apportioned appropriately according to the time period. And what are we talking about? The items in the consolidated statement of income. The items in the consolidated statement of income. While in this case, you're talking about what? The items in the statement of financial position. It doesn't matter. Even if in this case it was acquired on 1st of June 2025. Don't apportion. Don't apportion. That is another trick. So if you go to this one and you start apportioning, things will go marambas. You might score a 0, just imagine a 0, and there's no way in this case you can score 0 in consolidated statements. You can't score 0, so you just have to be keen about the simple things. The date of acquisition. Then in this case, you have to remember for the items in the income statement, you do apportion. The items in the statement of financial position, don't apportion. Don't apportion. Add them line by line. And if in this case they have any other adjustments, you can make them. So in this case, if you are told it was acquired on 1st of June, the subsidiary was acquired 1st of June. If in this case you are told PPE, you just add them line by line. You pick for the parent, you add that one for the subsidiary. Don't put times 7 out of 12 in the statement of financial position. Don't apportion. Don't apportion. Add them line by line and then make any other necessary adjustments. But don't apportion like what? In the income statement. That is very important. You need to take note of that. You need to take note of that. Now we can be able to look at this illustration. December 2024, question number 2B. So hope you are there. December 2024, question number 2B. December 2024, question number 2B. So December question number 2B. Yeah, so the question reads, on 1st of November 2023, KIP Limited acquired 75% of the interest in Lima equity shares. The acquisition was completed through a share-for-share transaction, where KIP Limited exchanged 2 of its own shares for every 3 of Lima's limited shares acquired. On the date of acquisition, KIP Limited share price was having to go for 40 shillings. You are given some summarized income statement there. You are told the summarized below are the statements